Welcome to a quick discussion of the at-the-money bell curve, the ATM bell curve, one of the three core principles of radioactive trading, but really one of the important three core principles to all options trading. Now, why are we having this quick discussion? Well, we had a YouTube comment from Install Express in the Why Use a Married Put video from September of 2018. After an initial comment and a response, Install Express said, "Thanks for the insight. I have not found any other info on the ATM bell curve that you talk about." Well, here is the more information in my reply to Install Express. The ATM bell curve is a trading sort of phenomenon that for any stock, the at-the-money option, the one closest to the current stock price, will always have the most time value and the most extrinsic value. As you move away from the stock price, going in the money or out of the money, whether we're talking about calls or puts, that value lowers. So there's less time value and extrinsic value when you're in the money or out of the money. And this gives us a key that in general, to maximize time value, we want to sell at the highest time premium or extrinsic value, and to minimize time value loss or risk, we want to be buying in the money or out of the money based on the strategy and based on your expectation for the underlying security. Here's a quick view from today at Costco, trading at around 11 o'clock, 10:55 a.m. at $366. We're looking at a call and put chain on power options for the November 20th expiration, 22 days away. Now, the 365 strike and the 367.5 strike are right at the money, closest to the current stock price. As we see here, they have the highest time value of about 2.8% for the calls and 2.8% for the puts. As we go to the lower strikes, the 350, the 340, and the 330, that time value gets smaller. And of course, as we go higher to the 375, the 380, the 390, the time value also gets lower as well. Now, the prices might increase, of course, as we go to the lower strikes. The calls are in the money, so we have a higher premium. But most of that is intrinsic value. So if the stock stayed exactly at the same price for 20 days, you'd keep that intrinsic value on the call, but you'd lose the lower time value. And same thing with the puts on the other side. The higher strikes are in the money, so yes, they have a higher cost, but the time value is much lower. The height is always at the money. And this is true for any expiration. Taking Costco as well, roughly 20 minutes later or so, we look at the April 2021 expiration, roughly 170 days out in time. The stock dropped a little bit. We're at 365.47, so the 365 strike is right at the money. And here, for both the call and the put, we see the highest time value at the current moment, 7.6%, 7.5% for the put option. But as we go to the lower strikes, the time value, the extrinsic value on the calls and puts gets lower. And as we go to the higher strike, where the calls are now out of the money and the puts are in the money, we also see that time decay and that time value percentage decay and get smaller. The at-the-money bell curve points us to the highest time value is always at the at-the-money strike. So what we see is then when we're buying options, whether for speculating on a market movement, or as protection for underlying security, or as protection for a different strategy, we typically want to be buying in the money or out of the money to be paying in to the lower extrinsic value. But when we're selling covered calls, naked puts, maybe doing some types of spreads, we do get the best premium, the best time value, the best extrinsic value when you're selling at the money. Now, this gives us an interesting phenomenon. Let's look over to the left of this slide, and just at the top here. Let's say we had a stock trading at 70. And at that time, the 70 put would have the highest extrinsic value, the highest time value because of the at-the-money bell curve. The 80 strike put, 10 points in the money, would be more expensive, but would have a lower time premium. Time passes. The stock moves from 70 to 80, and now what happens? Well, at that time, the 80 strike put that was in the money with intrinsic value and a lower extrinsic value than the 70 put has now seen a swell of extrinsic value. It is now at the money, so that extrinsic value has swelled. We might have given up some intrinsic value, of course, but this is the benefit of the at-the-money bell curve that can be manipulated. Let's take an example. AGCO Corporation on September 23rd, the stock was trading at $70.59. A few months out in time, the February 80 strike put in the money is priced at $13.30. $9.41 of that price is the intrinsic value, the difference from the 80 strike put to the stock price at $70.59. The extrinsic or time premium is only $3.89. So if I opened a married put on AGCO on September 23rd, I might have bought shares of stock at roughly $70.59 and bought the February 80 put for $13.30. If the stock stays at the same price between now and February expiration, just stays at $70.60, I'd expect to lose the extrinsic value. The time value would decay, but that's only $3.89 or 4.6% of the total cost of the stock and the put. I could exercise that put at 80 and get $80 back, so that $9.41 intrinsic value I kept. But back over to the left here, we see what AGCO did over a 1-month time period. From September 23rd, the stock at $70.59. Then 1 month later, on October 23rd, before the recent pullback, the stock was trading at $82.82. What does this mean for the at-the-money bell curve? On October 23rd, the stock closes at $82.82. Our February 80 put, which is now at the money or slightly out of the money, is priced at $6.05. So did I lose $7.25 on the put? Yes. But in order to lose that $7.25 from the $13.30 we paid in, now that the put is only worth $6.05, we gained $12.23 on the stock. Now remember, the original time premium, when the stock was at $70.59, and we purchased the 80 put at $13.30, $9.41 was intrinsic, only $3.89 was the time value or the extrinsic value, the true risk in a married put position. A month passes, time has passed, and now the stock is up, and our out-of-the-money put, which is all extrinsic, is at $6.05. So we gained $2.16 of extrinsic value and time value, even though 30 days have passed. How can we have gained time value when time passed? Well, that's why I use this term extrinsic value, because it's a combination of sort of the volatility, the time remaining to expiration, and other factors. But this is the at-the-money bell curve in action. We had an intrinsic price of $9.41 and an extrinsic or time value price of $3.89 on September 23rd for 80 strike put when the stock was at $70.59. Now that the stock has moved up and our put option is at the money, that $6.05 value is all extrinsic because we're out of the money by $2.82, but we've seen it rise $2.16 up to a price of $6.05. Now that the time value has increased, I can manipulate that following the rules in the blueprint at Radioactive Trading to lower my risk, generate some premium by closing this put and taking in $6.05 of extrinsic when I only paid $3.89 to begin with. And again, that 941 of intrinsic is covered by the $12.20 gain on the underlying stock price. So that is the at-the-money bell curve, one of the three core principles of radioactive trading. And if you think about it, all options trading strategies. The at-the-money bell curve tells us that we want to be selling near the money to generate the highest time value, the true profit on the position. And when we're buying for speculation or protection, we typically want to be buying in the money or out of the money to be paying into a less time premium or less extrinsic value. The other core principle is the time decay curve, or the red line. And for the Married Put approach, this shows us that when you're buying far out in time, 150 days, 120 days out, you get a slower time decay. And then the time decay rapidly kicks off in the last 30 days, 14 days or so. So what does that tell us? Again, when I'm buying, I want to be buying further out in time to see a slower time decay on my position if the stock's not performing as I expect. But when I'm selling, I do want to be selling nearer term and at the money as well, but I want to be selling nearer term to get the more rapid time decay in my favor. And of course, the most important principle for all options trading is proper position sizing, FIST, forcing an ideal sized trade, so that any position that I enter is not risking more than a few percentage of my total portfolio value. Of course, with the Married Put position, we've got that forced into the proper position. We have a known, guaranteed, limited risk position, and using some of these manipulations we're talking about with these three core principles, we can eventually minimize that initial low risk and potentially bulletproof the trade where we have no risk on the position and still unlimited upside profit potential. So for Install Express, that's our discussion on the benefits of the ATM Bell Curve, what it is, and how we manipulate it using this strategy. This, of course, is all described in the Blueprint course at RADIOACTIVETrading.com. It teaches you how to control risks to single digits, even in the worst case scenario. The Blueprint also has the full description of the 12 different income methods to help you generate income, which will lower the risk of the initial position. You can manipulate the ATM Bell Curve and time decay in different scenarios, and it can help you bulletproof your positions where you have no risk and still unlimited upside. The Blueprint also contains chapters on exiting and combining income methods and a whole lot more. So for more information about how to control risk and get income in the proper fashion, go on over to RADIOACTIVETrading.com and click on the products link there to evaluate the Blueprint and see more details. You can see the full table of contents and even listen to the first chapter for free right there at RADIOACTIVETrading.com. So I hope this was useful information regarding the ATM Bell Curve, how we use it, how it can be manipulated, and how it applies not just to the Married Put trading, but really to all options strategies.